If you follow tech markets, you've seen the drop in the main cybersecurity ETF, CIBR, falling over 11% this year, creating serious anxiety among investors. It's easy to look at that sharp sell-off and assume that enterprise demand for cyber defense is drying up. This chart shows exactly where the disconnect is. The red line tracking CIBR pricing is dropping, but those ascending bars show end-user security spending is actually projected to rise to about $240 billion by 2026, up from $213 billion. The sector is down because the broader market is repricing software. Investors are rotating capital toward AI infrastructure and cashing out of application software, creating a broad buyer's strike and a sector-wide valuation reset. When Wall Street panics over multiples, while corporate spending continues to climb, it creates a mispricing. For investors willing to look past the immediate red ink, that gap is a serious opportunity. The specific catalyst making investors nervous right now is the sudden arrival of advanced defensive AI. Anthropic recently launched Project Glasswing, giving select organizations access to their Claude models specifically for cybersecurity. The immediate market reaction was defensive. Investors worry that advanced AI will seamlessly automate the detection and triage workflows currently handled by human analysts. That creates a direct fear trade. If an AI handles the operational work, customers need fewer human analysts, fewer software vendor seats, and fewer overall products. But the bullish perspective offers massive upside. Elite defenders arming with these models will get significantly faster at finding and fixing vulnerabilities. The vendors that successfully operationalize these frontier models stand to heavily widen their competitive moats. AI is aggressively reshuffling which companies capture cybersecurity revenue, shifting market value from isolated tools toward integrated ecosystems. This brings us to your first major capital allocation choice, shifting investments into broad, integrated platform vendors. Large enterprise customers are exhausted by managing dozens of fragmented security tools. They actively want fewer vendors and are demanding unified solutions that secure their endpoints, cloud environments, and networks all at once. That trend heavily favors established leaders like Palo Alto Networks and CrowdStrike. Notably, both of these companies are official launch partners for Anthropic's new AI initiative. The financial data proves this model works. Palo Alto recently reported their next-generation security annualized recurring revenue grew by 33%, hitting $6.3 billion. The trade-off here is price. To own these elite platforms, you have to pay a premium valuation multiple today and accept near-term stock volatility if the tech sector continues its broader rotation. However, paying that premium buys scale. In an environment where AI models rely on vast amounts of telemetry, owning the proprietary data and the entire workflow creates a significant defensive moat that is difficult for smaller competitors to bridge. The alternative strategy might seem tempting, buying up narrow, single-category software vendors simply because their stock prices look cheap after the recent sell-off. When you plot disruption risk against platform breadth, narrow tools land in the high-risk bottom left quadrant. Broad platforms like Palo Alto and CrowdStrike sit safely top right. As AI platforms get smarter, standalone features are quickly absorbed and natively automated by broader ecosystems. Getting a discount on the stock price doesn't matter if the underlying product is slowly made obsolete by a larger competitor. That presents a serious risk of permanent capital loss as the industry consolidates. In an AI-driven market, owning a single feature rather than a full platform workflow is a toxic asset, no matter how heavily discounted shares become. If you want a different risk profile, you can look at companies with mixed or indirect AI exposure, starting with identity and access management leaders like Zscaler and Okta. Identity security remains absolutely essential, but the market is cautious. Investors fear that AI will intensify competition in this specific space and compress these companies' pricing power. The trade-off for these mid-tier names is straightforward. They offer solid baseline fundamentals and double-digit revenue growth, but they lack the hyper-growth narrative required to justify a premium tech multiple. You also have the option of the megacaps and integrators, specifically Microsoft and Accenture. Microsoft is embedding frontier AI models directly into its broader productivity and data workflows. They are shaping the architecture of AI-era security from the top down, offering a way to invest in the cyber upgrade cycle indirectly. By hiding in megacaps, you dilute your pure-play cybersecurity risk. You trade away explosive, sector-specific growth in exchange for lower overall portfolio volatility. Underpinning this entire market rotation is a persistent myth, the idea that artificial intelligence will eventually automate security so perfectly that total defensive spending will shrink. The reality is that AI actively expands the total attack surface. It rapidly generates new code vulnerabilities and empowers millions of autonomous machine identities that all need to be governed and secured. At the same time, large language models lower the cost and effort required to launch offensive cyber attacks. This permanently increases the total volume of incoming threats. With AI driving both the frequency and sophistication of attacks, cybersecurity remains a structural, long-term secular growth market backed by clear operational necessity. Capital allocation from here requires matching your specific time horizon and risk tolerance to the realities of this new landscape. This decision tree maps out the paths. If you are a passive, long-term investor facing ETF volatility, holding the broad ETF captures the macroeconomic expansion of total market demand, protecting you from picking individual losers. For active growth investors, the strategy shifts. Active investors should consolidate capital into established platforms like Palo Alto and CrowdStrike, companies with the scale and proprietary data to actually weaponize AI. Meanwhile, value-conscious stock pickers should look for lower multiple, integrated security stacks like Fortinet, which balance strong profitability with the industry's broader consolidation trend. To succeed as a cybersecurity investor in the AI era, you must prioritize platform breadth and data ownership. Those who own the workflow will thrive. Those who only own a feature will be left behind.